You guys can turn on your cameras and appreciate it. It's easier to talk to live people than to gray boxes.
Recording in progress.
Okay, folks, welcome. I am glad you joined me. A couple of things before I get started. One is a reminder that your first quiz is a week from today. I sent out the kind of overall picture, in terms of, on Monday where I sent out the review session, the past quizzes. So try to, work on some past quizzes. The best way to actually prepare for this class is to work through prompts, not read through the slides and review the prompts, but actually work through the prompts. So work through them. So it's a week from today. It will be in person in Paulson Auditorium. And if you're unable to make it because you're trapped in a foreign location, you can't make it to New York, or you have health reasons for not coming to class, please make sure you enter your names into that Google Shared spreadsheet that I sent, because I will make sure that you get the exam at the same time as the rest of the class and you end your exam at the same time, but you have to be on that Google Shared spreadsheet to be able to take the exam remotely. Because if you're coming to class, you don't have to do any of that stuff, just show up. Okay. It'll cover everything we do through today and a little bit of what we do on Monday through cash flows. So today we're going to complete our discussion of discount rates, move on to cash flows, and on Monday we'll finish up cash flows, but it's through slide 162. I think I sent you the actual slide number we'll be through. It's a lot to do. So any questions before we start about the quiz, about what's coming? It's open book, open notes, no open laptops. You can bring a calculator. You can have your iPad open because your notes are in there. You can even have your laptop open if that's where your slides are. You just can't work on Microsoft Excel for the moment. I just think it's dangerous to have Excel because I found it actually creates more problems than it solves, because you got stuff on an Excel spreadsheet, transferring it to a quiz can be problematic. So any questions on the quiz before we start? Okay. So let's talk about the rest of the cost of capital discussion. Now, I know it's been a long time since our last class, but we talked about the ingredients that go into cost of equity. Let's review. Okay? The advantage, I can see your faces finally after a few weeks, and now I can actually pick on people, because when you can't see people's faces, I feel tough. And it's tough to call on them because it feels like you're calling on somebody who's trying to be invisible. So Douglas, you want to help me out? So we're going to go through the cost of equity ingredients, and I want your help on the first ingredient. So if somebody comes up and says, I need a cost of equity, what risk-free rate should I use? What guidance could you offer?
Use the T-bond rate as the base.
Before you do that, did you ask me whether I was doing things in US dollars, right? I mean, the first thing you would ask is in what currency. Never answer a question about risk-free rates without talking about currency, because clearly, if I'm doing things in Vietnamese dong, the T-bond rate is not the right risk-free rate. So it's going to depend on the currency of choice, not the country that the company is in, right? So if I'm doing a Russian company in euros, my risk-free rate has to be in euros. Obviously, more work in some currencies than others. So it's US dollars, you're right, the T-bond rate. But if it's Indian rupees, you start with the government bond rate and clean it up. Scott, since you're right next to Doug on my screen here, so now I come to you for an equity risk premium for a company. Guide me on what I should be doing for equity risk premiums.
So you are going to want to understand first, I guess, what markets you're looking to be in, what countries you're exposed to, and the volatility of the exchange.
I'm glad you said that. It's not the country you're incorporated, it's where you operate that drives your equity risk premiums. And then, of course, we come up with the equity risk premiums for those countries or regions and take a weighted average. Doesn't have to be revenue weights, it could be operation weighted. But equity risk premiums, so risk-free rates reflect your currency choice. Equity risk premium reflect your geographical choices. Rakesh, last input, beta. Guide me on how I get a beta for my company.
If we have to look at the volatility of the cash flows of the company vis-a-vis the volatility of the market, this is one thing we can do.
Which is by doing what? So give me the mechanics of what I'm doing here. So, because volatility is just two numbers, how do I convert it into a beta number that's a single number?
Yes. We can look at the standard deviation of the return of the stock vis-a-vis.
But that won't tell me what a beta is, right? Beta measures how I move with the market. Standard deviations by the Simpsons tell me overall volatility.
Yeah,
so at least in the traditional way, what do we do? We run a...
We do a regression.
Okay, so the standard way of estimating betas is to run a regression. Works if you have a publicly traded company of historical data. But I think we dug a pretty big hole for betas and buried them, right? I hope I did.
Yes.
Because they're backward looking, they're noisy, they reflect a company as it used to be. So Mansi, what was our alternative to a regression beta? What do we do?
So because regression wasn't working for us because it was backward looking, we looked at the future cash flows that we can get and then we discounted it.
No, but to get a discount, you need a discount rate, right? To get a discount rate, I need a beta. So when I look at the future cash flows, I look at the business of businesses those cash flows are in, and I look at the betas of the businesses and I build up to a beta for my company. Why do I do it? It's more precise, it's more forward-looking, and it reflects my company as is, and it expects to be. Notice that each input has its own role, right? Risk-free rate carries my currency weight. My equity risk premium reflects the geographical areas I operate in. My beta reflects my business choices. I've got my cost of equity, risk-free rate plus beta times equity risk premium. But that's just equity. So today I want to talk about the cost of debt because there are two ways you can fund a business, equity or debt. We haven't talked about the cost of debt yet. So to start that process, I'm going to start with the test like we do every session. So let's assume that a company has called you in to estimate a cost of debt. They already have $1 billion bank loan they've taken, and they've locked in the interest rate at 4% for let's say for the remaining 8 years. For the next 8 years, their interest rate is going to be 4%. But right now, the T-bond rate is 5%. And this company, if it went out and borrowed money, would face a default spread of 2%. There's credit risk in the company. You ready? Very simple question. You have to get a cost of debt to put into your cost of capital. I'm going to give you the choices and you tell me whether these choices work. And if they don't, tell me why not. I could just say, look, your cost of debt is 4%. Why play games? You already have the bank loan. It's locked in at 4%. Carlos, what's wrong with that choice? Why is that? No.
4%. Because you have to, I mean, what I would do is like, take the average cost of debt, right? So
which is 4%. So right now,
but now you are issuing more debt.
But what if I don't plan to issue any more debt? What if this is the only debt I need? I'm a mature company.
Fair enough. So I would take 4%.
Okay. Can I push back? What's the risk-free rate right now?
5%.
5%. You're telling me it costs you only 4% to borrow money. Let's play a game. You're taking this debt, you're taking projects with this debt, right? Let's suppose you have a project that's close to 100% funded with debt. So right now, your pre-tax, forget about tax benefits, your pre-tax cost of debt for this project is 4%, because you're funding it primarily with debt, your cost of capital is going to be roughly 4% as well. If you take this to the next step, then if this project makes 4.5%, you would take it, right? It's higher than your locked in cost. But you see the danger of doing that? You can make 5% risk-free. Why would you take a project making 4.5% if the risk-free rate is 5%? The problem with the 4% cost of debt is it cannot be a cost of debt if the risk-free rate is 5%, and you can take investments that make guaranteed returns at 5%. No, but Carlos, you have lots of companies. This is called the book interest rate. An amazing number of DCFs that I see, the cost of debt is a weighted average of all of the debt you have on your books. And not surprisingly, that reflects not just the rates you used to borrow at, it also is determined by whether you have short-term debt or long-term debt, right? Because if you have a term structure that's upward sloping, if you have a lot of short-term debt, your cost of debt looks low. It's a recipe for all kinds of inconsistent actions. So I'm laying the foundations for use of cost of debt. It shouldn't be a book cost of debt. Even if you don't plan to borrow any money, it's got to be the rate at which you can borrow money long-term today. In other words, I'm not going to let you play games with the term structure and make it look like your cost of capital went down. It's the rate at which you can borrow money today. I've kind of led you to the answer. What's the rate at which you can borrow money today? It's not 4%. It's not even 5%. It's 7%.
7%.
I've just made your life a lot easier, right? Because now when you compute the cost of debt for a company, you don't have to look at all. There are some companies with that, which have 50 debt issues on their balance sheet. Computing a book interest rate is like taking this weighted average and saying, you don't have to do that. Just look at this company right now. Tell me what the credit risk is in this company. And we'll talk about easy companies to do this on and difficult companies and build up to a cost of debt. Risk-free rate plus default spread. So it's not 4, it's not 5, it's not 7, it's not an average of book and market. 7%, I'm sorry, it is 7. So basically it's a 7% is your pre-tax cost of debt. Let me follow up though. I told you have $1 billion in bank loans outstanding, right? Let's suppose this company has a market value of equity of $1 billion. Remember, to get a cost of capital, I need weights on debt and equity. So it looks like it's 50% debt, 50% equity, right? $1 billion in debt and $1 billion in equity. So the answer should be 50%. What am I missing when I say it's 50%? Anybody want to give it a shot? Do I really have $1 billion in debt?
It would be the tax shield.
No, forget about the tax. You're right. There is a tax shield, but that's separate. There's an after-tax cost of debt. But the book value of debt is $1 billion. Jillian, you want to try?
Yeah, you should be using the market value of the debt because you're using market value of equity.
Okay, so if I were the company, I'd say, look, but these are bank loans. They're not traded, but you can still estimate a market value, right? How do you estimate a market value? Remember that I have $1 billion in book value of debt. I have a coupon rate of 4% on that debt. My market interest rate is 7%. Do you remember how to price a bond? When you price a bond, what do? You take the coupon rate, the face value, and you discount it back at the market interest rate. If I take the interest payments on this loan and the face value and discount them back at 7%, which is higher than my coupon rate, guess what I'm going to get as my market value of debt? It's not going to be $1 billion. It's going to be a number lower than $1 billion or higher than $1 billion. Let's see if you remember your bond pricing. Coupon rate is lower than the market interest rate. My price for the bond will be
lower.
It'll be below par. It'll be like $870 million. The excuse that a lot of investment banks use for using book value of debt is not traded. We can't get a market value. That's lazy because you can convert book debt to market debt if you know what the interest payment is and the remaining maturity in the debt is. And that's effectively what you need to do here. So you need to use the current cost of borrowing and a market value of debt, even if your debt is not traded, if you want to get to cost of capital. So that's what today's class is going to start with, is estimating the default spread. So let's talk about the cost of debt. So let me lay the foundations. I come to you with a company, I want a cost of debt. To get to a cost of debt, you need a risk-free rate. That's going to be easy, right? Because by the time you get to the cost of debt, presumably you've done cost of equity, which started with the risk-free rate as well. So once you've defined the currency you're working in, whether it's euros or dollars, the risk-free rate is the risk-free rate for both cost of equity and debt. The only number that I need for a company to get the cost of debt is the default spread. The default spread for borrowing long-term. Let's start easy. If your company has bonds outstanding that are publicly traded, getting a default spread should be straightforward, right? You can look at the interest rate on that bond and use it as your pre-tax cost of debt, saying, why am I looking for things that I don't need to look up? The bond is traded as an interest rate. Be very careful when you do that. And here's the reason. Can a risky company issue a safe bond? Yanis, you want to try? Can a risky company issue a safe bond?
I would say no. Because
When you're a bond buyer, what do you think about when you think about risk? What are the assets that back it up, cash flows? What if I'm a risky company? I take my safest assets and I secure the bond with my safest assets. That's what you do with senior debt, right? You give them priority of claims. A risky company can issue a safe bond by just slicing off portions of the company. What that means then is if you look up the interest rate on a bond for a company and treat it as a cost of debt for the whole company, you're going to understate the cost of debt for the company because you've taken their safest bond and given that cost to the rest. My suggestion is, even if your company has bonds outstanding, don't use the interest rate on the bond as your pre-tax cost of debt because you don't know what you're getting, what slice of the company. But if you have bonds outstanding, there's something else out there that can help you assess default risk, right? When companies issue bonds, what do those bonds usually come with? They're not required, but almost every bond comes with this as kind of a good housekeeping stamp. What does every bond come with if you're a bond buyer?
Isn't it a covenant?
It comes with covenants, but that's a pain to read. You want something, you're lazy as a bond buyer, right? Who wants
Ratings?
You look up ratings. I know you're trusting ratings agencies then, but S&P and Moody's and Fitch rate your company. What is that rating supposed to do? It's supposed to be a measure of the default risk in the company. So when S&P says this company has a AAA rating, you assume it has less default risk than a BBB rated company. The ratings agencies, at least on average, have got this right. Look at the tables by ratings. Clearly, they are predictors of default risk, even though they might be delayed predictors. So if you don't trust a bond, you can always go with the rating to come up with the default spread. That'll work for about 15% of global companies. Their bond ratings, you can use the rating and say that's a default spread that goes with it. That leaves us with 85% of companies that don't have bonds or bond ratings. They borrow from banks. So what I'd like to talk about today is something we talked about in corporate finance, which is assessing a rating or a default spread for a company that doesn't have a bond rating. And I'm going to use a very simplistic approach to get to this rating. We know what ratings agencies use to rate companies, right? They're pretty open about it. They look at financial ratios, interest coverage ratio, EBITDA to fixed charges, debt ratios. So they look at a collection of 8 or 10 ratios and essentially use those ratios to assign ratings. So that's what I started with. I looked at the 8 to 10 ratios, and then I tried to find the ratio that was doing much of the work in terms of explaining difference in ratings. The ratio that I ended up using to estimate ratings was one ratio, an interest coverage ratio, operating income divided by interest expense. Again, let me be quite clear on why I'm picking this ratio. I'm not saying it's the best ratio or the most informative ratio. This is the ratio that best explains differences in ratings across actually rated companies. So if you tell me the interest coverage ratio for your company, I might be able to give a rating for your company based on the interest coverage ratio. So I started this process about 30 years ago. First time I did it, I took every rated company. I looked at the ratings and the interest coverage ratio, and I created a lookup table. You guys have used lookup tables in Excel, right? You tell me your interest coverage ratio, I'll guess your rating. So let's make this real. Let's assume that you're looking at Embraer. Okay? The interest coverage ratio, as I said, is operating income divided by interest expense. For Embraer, that ratio is 3.56. Now, before I go any further, as a lender to a company, do you want this ratio to be a high number or a low number?
High number.
You want the number to be as high as possible. You get more buffer, right? If I can somehow convert that 3.56 into a rating, that'll make your life a lot simpler. In 2004, that's exactly what I did. I had a lookup table, and you can get the 2022 version of my website, where you tell me two things. One is, how big are you as a company in terms of market cap? You're saying, why does that matter? Well, ratings agencies seem to have two sets of rules. For big companies, they give you a higher rating for the same interest coverage ratio than a small company. You're saying that's not fair? Well, it is what it is. So to me, big companies are companies with a market cap greater than 5 billion, and small companies are companies with a market cap less than 5 billion. Let's say you're a big company. In this case, Embraer is a big company, and you tell me your interest coverage ratio is 3.56. In the lookup table, that puts me right here. You look across, the rating I would give Embraer based just on the interest coverage ratio is an A- rating. That A- rating translates into a default spread based on what A- rated bonds were delivering in 2004 of about 1%. So basically, even if I don't have a rating, if you have interest expense and operating income, I can convert an interest coverage ratio. Coverage ratio gives me a rating. Rating gives me a default spread. Wakas?
Professor, will this be on average for a couple of quarters, or do we have a cutoff for this thing?
Okay. So think like a ratings agency, right? Let's say a company had a really good year last year. Do you want to give a rating based on last year? Probably not, right? You probably want to smooth things out, because think like a lender. That's all you want to do here. Think like a lender. You don't want to lend on a really bad year or a really good year. So the answer to your question is, if you have a company with cyclicality or lots of volatility, you might look at an average over 5 years. An oil company or an automobile company. If you have a company which doesn't have cyclicality, you might just use last year's numbers because the trend line is pushing upwards. There is no one set of numbers. The lookup table works for whatever coverage ratio you've computed. So if you want to average out, and that's what you're using, which is what I did for Embraer. I used an average over 3 years because I had volatile income, and I used that average interest coverage ratio. But the idea here is you want to push the coverage ratio to rating and the rating into a default spread, because once you're done with that, you're pretty much home free. Any other questions on this process? Now, I've actually presented this at S&P to their bond ratings group. And you know what the response is, right? This is so simplistic. Not only do we look at 9 ratios, we also look at qualitative information. And I say, you're right. But you know what? I can explain 60% of the variation in ratings that you deliver based just on this ratio. If I were a fixed income person, which thank God I'm not, then I want to finesse these ratios, because being off by 1 notch makes a big difference to me. Luckily, when you're valuing companies, being off by 1 notch or even 2 notches is not going to move your cost of capital much, right? So if you get an A- rating instead of a BBB+ rating, your cost of capital will barely move. I just want an approximate cost of debt when I do cost of capital, and this does it well enough. Now, one final point, to get a cost of debt for Embraer. Now, normally when you get a default spread, what do? You add it on to a risk-free rate, and you say, that's my cost of debt, right? But there's one complicating factor with Embraer that I have to bring in. It's a Brazilian company. You're saying, so what? This again is not fair. But if you have 2 companies with the same interest coverage ratio, both borrowing in dollars, one is a Brazilian company and the other is a US company, they walk into the bank to borrow money. They have the same interest coverage ratio. Guess which one's going to walk out with a higher cost of debt, with a higher interest rate on the loan? Almost every single time it's going to be the Brazilian company. Why? Because when you're a company in an emerging market, you carry 2 burdens on your shoulder. One is your own burden as a company. The other is your burden, is the burden of your country. If you want to talk about fair, talk to a Greek company that's had to borrow money for the last 10 years. They'll tell you how unfair this process is, because you can be the safest Greek company in the face of the earth. You walk into a bank, you show them their financials, and you say, oh, by the way, I'm a Greek company. The banker says 15% plus. So what? Yeah, look at my coverage ratios. I don't care. You're a Greek company. The way this is going to show up in my calculation is to get a dollar cost of debt for Embraer. I'm going to start with the T-bond rate. 4.2, I think it was 4.29% when I did this. I'm going to add the 1% default spread I got from my synthetic rating. But then I'm going to stop and ask, how much of the Brazilian default risk will Embraer bear? There used to be a time when ratings agencies used to have what was called a rating ceiling for companies. Do you know what a rating ceiling was? That no company in a country was allowed to have a rating higher than the country it was in. Incredibly unfair if you think about it, right? Because we're a Venezuelan company. What are you capped at? What is it? Venezuela is a double C. You can never be, you can be all cash. The safest company, they said, no, you can't be double C. Ratings agencies have removed the explicit constraint, but implicitly, if you look at ratings for emerging market companies, you'll find that they're consistently lower than for developed market companies. That's a country risk burden. So what I did was I took the 6% default spread. This was a time when Brazil was a really risky country, 6% default spread. I attached only 2/3 of that spread to Embraer, and here's why. Embraer gets almost all of its revenues outside Brazil. You could actually argue that Embraer is in fact safer to lend to as an outside lender than the Brazilian government if you're lending in dollars. So I'm opening the door to allowing for the fact that some companies are not hit with the entire country risk burden. But if you're looking at a small Indian company, I would attach entire Indian default spread onto your cost of debt. A small Indonesian company, the entire Indonesian default spread to your cost of debt, because I don't think you can escape this trap because you're going to carry both country risk and company risk. So if you're computing a cost of debt for an emerging market company and you're doing it based on synthetic ratings, remember to add this ingredient of country default spreads to your cost of debt, which will push up your cost of debt in whatever currency you're working with to reflect the fact that you're both company and country risk in that cost of debt. Implicitly, many of you use the government bond rate as your risk-free rate. You've been doing this, right? Because it's been built into your government bond rate. I'm just breaking it down. So be very clear about why your cost of debt is high. It's not because your company is risky, but because you're building some country risk into every one of your costs of debt. Any questions on cost of debt? I told you how I got this table, right? I looked at rated companies. Go ahead, Sarah.
I just wanted to double check on the 2/3. Is that just like an assumption?
You know what you can use? Remember how we got lambdas when we did cost of equity? You can use a lambda in there or a revenue base. If you know, so if you want something more, this I got by looking at, there were, I think 7 big Brazilian companies were all borrowing long-term outside Brazil in 2004. So companies like Petrobras and Embraer. Basically, I took what they were borrowing at outside Brazil and I looked at what the Brazilian government was borrowing. That 2/3 was what it looked like then, but that's a lot of work. So if you're estimating a lambda to do cost of equity or something to reflect the fact that it gets a bulk of its revenues outside, you can use that in here as well as a replacement for the 2/3. I think we got a lambda of 0.27 for Embraer. You can plug that 0.27 here. Now, this table that I just showed you, the lookup table, I developed in the 1990s by looking at rated companies globally. But I'll make a confession. 95% of the companies were rated globally in the 1990s were US companies, which means that this is a table that was built up originally by looking at US rated companies. Even today, the bulk of the companies in this group are US companies with European companies thrown into the mix now. And the question is, will this table travel? And let me explain. I had to value the PZ Cousins Nigeria, Nigerian consumer product company. There's no rating. I had to come up with the cost of debt. I used this table to estimate the rating and default spread for PZ Cousins Nigeria. When I was in Vietnam, I had to estimate a cost of debt for Vinamilk. I used the interest coverage ratio rating, saying, can you do that? No, clearly I did it, whether it's the right thing to do it. But I'll give you some caveats on this table and when you might want to be a little careful about using this table to come up with the default spread. Let's suppose you're looking at a country where risk-free rates are 15 or 20 or 25%, which is what I faced in Nigeria. The Naira's risk-free rate was 15%. If your risk-free rate is 15%, even if you're a safe company in that country and you're borrowing in the local currency, your interest expenses are going to be high simply because the rate is high. It's very difficult to get interest rate coverage ratios of 6 or 7 or 8, which is what you need to get a really good rating if your interest expenses are based on a risk-free rate of 15%. What I'm saying is this table will probably understate your rating if you're a company in a market with very high risk-free rates, because it's built off a country where risk-free rates are much lower. There are ways you can tweak the table. You can lower the coverage ratios across the board for countries which have 15 or 20% rates. But just to, I do use the table. I do tweak it sometimes when I'm in countries like Nigeria, but most of the time, I just take the table and run with it because it's really a table designed to come up with an estimated rating. I'm not a ratings agency. Nobody can hold me accountable on actually getting it perfectly right. I just want an approximation of the cost of debt. I'll tell you the other set of companies that some of you will run into. In fact, I know about a fifth of the class will run into this problem. What did I make you do? Pick companies who are money-losing companies, right? At least one person in every group has a money-losing company. If you have a money-losing company, what's the interest coverage ratio going to look like? EBIT is negative, right? Interest expenses obviously are interest expenses. Your interest coverage ratio is negative. You've just gone off the table. You're in default, right? If I use the table, which is silly. If you put a D rating on your debt simply because you're a money-losing company, the cost of debt is going to be 18, 20%. You're saying, what do I do that? First, gain some perspective. In fact, somebody emailed me over the weekend. I don't remember. It might have been somebody from the class on trying to get a synthetic rating for their company. I think it was Airbnb. Was it somebody from this class? No. They'd spent a few hours on this because they'd wrestled with how. So I asked, and I said, how much debt does Airbnb have? And the answer was about 2 billion. And I said, what's the market cap? It said 110 billion. I said, what's the debt ratio for the company? It's about 2%. I said, if your debt ratio is 2%, what does it matter whether your rating is AAA, BBB, CCC? Your cost of capital is pretty much going to be the same. So have perspective. When you have a young money-losing company, especially if it's a tech company, there might be some debt, but it's going to be such a small number, such a small percentage, that you might as well just estimate a rating and move on. It's not worth beating your head against the wall for debt ratios of 2 or 3%, trying to figure out what. Now, my suggestion is use an investment grade rating and move on, simply because you're assuming your company is a going concern. You don't want to put it into default right away. Give it a BBB rating. If somebody makes a big deal, ask them what they'd like the rating to be. If they want it to be single B, concede it. This is one of those things where you can concede to anybody pushing back. It's not going to make a heap of difference to your overall cost of capital. Now, of course, once you get the rating, you need default spreads, right? And can default spreads change? Of course. And they can change a lot. This is 2008. Let's take let's take investment grade, BBB. Let's suppose you're a BBB rated company. You started 2008 as a BBB rated company. Your default spread was 2.02%. Your rating didn't change over the course of the year. By November of 2008, your default spread had climbed to 5%. Your rating hasn't changed, but your default spread had gone up. You're saying, why? Remember, 2008 was the crisis. Remember what happened to equity risk premiums? The same thing happened to default spreads. Kind of an indirect way I'm saying, don't get stuck on what the default spreads were in 2019 or 20. You got to update these numbers. In fact, in 2022, here's what default spreads look like. They dropped back to levels that were lower than they were pre-COVID. Like the equity market, equity risk premiums had come down, default spreads had also come down. That was January 1st, 2022. Guess what those default spreads have done in the last 2 months? As equity risk premiums have climbed, these default spreads have gone up. So if you're valuing your company on February, whatever, today, 23rd of 2022, you might not want to use the spreads as of the start of 2022 because you want updated numbers. I'll send you a link on a way you can update these numbers. You can either get it on Bloomberg with one command, or you can get it from this macro site for the Federal Reserve site that I sent you, where you can get updated spreads for AAA, BBB, CCC. But you want to use updated spreads because you want a cost of debt as of right now. Any questions on default spreads? As I said, 2020 was an up and down year. Here you got the default spread, let's say on a BBB rated bond, started the year at 1.33%. No, 3 months later, that number was almost 3.73%. Default spreads almost tripled in the first 3 months of 2020. By the end of 2020, they were almost back to where they were before COVID. So again, something to think about. When you estimate hurdle rates, everything's changing, right? Your risk-free rate is changing, your equity risk premium is changing, your default spreads are changing. And it's your responsibility to make sure those numbers reflect the market as it is today, not the market as it was 2 years ago, 2 months ago, or 20 years ago. One final point about debt, and then we'll kind of get ready to tie up loose ends. Now, sometimes companies have access to what I call subsidized debt. You know what subsidized debt is? That people are lending it money at a rate lower than what you would charge given their default risk. You're saying, why would they do that? Well, it could be because they want to encourage the business, the companies, and green energy companies used to get subsidized loans from the US government. Like one of the most famous subsidized loans, the one that Tesla got very early in its life. These subsidized loans allow the company to borrow at a rate that they could not borrow if they went to the market or they went to a bank. So I'm going to pose a question around subsidized debt, and I'd like you to help me out. So this is Embraer. Now, Embraer is a company the Brazilians and the Brazilian government are very proud of, because it's a manufacturing company. It's a global manufacturing company. It's a source of great pride that you built a manufacturing company that can compete with the Airbuses and the Boeings of the world. So for a long time, the Brazilian government lent money to Embraer at subsidized rates. How subsidized? Remember the cost of debt that I got for Embraer was like 9.29% if you brought in the country risk and the company default risk. The Brazilian government lent them the money at about 6%. So they've got access to subsidized debt. My question is a very simple, pragmatic one. I'm sitting down to value Embraer. I know that they have access to subsidized debt of 6%. I need a cost of debt in my calculation. And here are my choices. I can go with the subsidized debt cost because it is a real cost. It's a cost at which I can borrow money today. I can go with my synthetic cost, 9.29%, which is much higher. Or maybe there's a number I should pick in the middle. What should I do when I do cost to cap for Embraer? Should I use the subsidized cost of debt, the market cost of debt, or is there a way I split the difference? Go ahead, Carlos.
Okay, I would say like, if you are, for example, like forecasting 5 years,
yeah,
I would check if I can borrow at this subsidized interest rate for, if it's 5 years, I would use it. And maybe for the terminal value, I would use like an average.
Or you could use 9.29 if you think this is a 5-year loan that it runs out. In fact, I think Carlos has opened the door to what many people seem unwilling to do in discounted cash flow valuation, which is your discount rate can change over time, right? This notion that you have to one chance of doing the discount rate and then all your options are off the table is absurd. So you can start the valuation with a 6% subsidized cost of debt because you have access to it. But then as you get closer and closer to the terminal value, I would suggest pushing to your market cost of debt, because remember that cost of debt you have in year 10, it's not just year 10, it's forever. And subsidies don't last forever. Okay. Ioannis, you have something to add to that?
I would stick with the 6%, provided that there was a reasonable belief that the subsidy was actually going to pan out. Like if there's a 3% discount in Venezuela, I'm going to ignore it. I'm going to take the conservative approach.
Because you don't trust the government's guarantee, right? Basically, it's a question of how much do you trust the government? But remember, even trustworthy governments don't give you subsidies forever. The subsidies for green energy are going to go away. You know when? and green energy stands on its own feet. Tesla actually paid off its subsidized loan early. And herein lies the other reason you should be a little wary of subsidies. This may be cynical, but governments never do anything for nothing, right? If you get a subsidy from the government, there's always another shoe waiting to drop. So when you take that 6% loan, this is not a freebie. At some point in time, the government is going to come back and say, you remember that loan we gave you at a subsidized rate? We'd like you to do this, this, and this in return. So one thing it might be worth doing is leave the cost of debt at 9%. This is the alternative, what Carlos suggested, where you use this. Leave the cost of debt at 9.29%. Value the company with the 9.29% cost of debt. Obviously, you're undervaluing the company because you're not factoring in the subsidy, but the subsidy is very easy to value separately, right? What's the value of the subsidy? You're able to borrow at 6% of 9.29%. You take that savings, you show it as a separate line item, say, this is the value of my company without the subsidy. This is how much I'm gaining because I have the subsidy. So if the government takes it away tomorrow, you know what? I can take it out of my valuation. It's separated from the rest of my valuation rather than swimming with all these other numbers. So either build in the subsidized cost, but for a limited period and then let it phase out, or ignore it completely and value it separately as a separate slice and say, this is how much the subsidy is worth. So, the company can decide for itself whether it's worth going after the subsidy in the first place. One final point, you got everything I've said so far is about getting a pre-tax cost of debt, right? Risk-free rate plus default spread. But remember, in much of the world, debt comes with a tax advantage. Interest expenses are tax deductible. And the way you usually show this in your cost of debt is you multiply your pre-tax cost of debt by 1 minus the tax rate. So I have a very practical question. What tax rate should I be using for the cost of debt? I think we answered this in corporate finance, but let's see if we remember it. What is the tax rate I should be using to adjust my pre-tax cost of debt? What do you mean, what tax rate? Here are the choices. You can use an effective tax rate, which is like an average tax rate across all your income. You can use a marginal tax rate, which is the tax rate in your last dollars of income. You might use some average of the two. Which tax rate should I be using when I do after-tax cost of debt? Bunzi?
I'm gonna say the effective tax rate.
Okay. Which is an average tax rate, right? So let's play a game. Let's suppose you have a company with $10 million in operating income. You have $1 million in interest expenses. Let's play through. So you have $1 million in interest expenses, you subtract the million, report taxable income of 9 million, right?
Right.
And you pay taxes of 9 million. Think of where you saved on taxes. You didn't save on the first million. You didn't save on the middle million. You saved on the last million.
Right.
So in a sense, the reason for using marginal tax rates, interest saves you taxes in the margin. It can make a huge difference. And I'll tell you why. You take a company like Apple, its effective tax rate is about 16%. Why? Because it's a global company. It's got revenues, multiple parts of the world, low tax, high tax. They have about $100 billion in debt. Guess where all of that debt is parked? What part of the world does Apple have almost all of its debt? It's in the US. It's not in Ireland. It's not in Hong Kong. It's in the US. You know why? Because it allows them then to take the interest expenses they have and claim it against their taxable income in the US, on which they're taxed at 26 or 27% if you include state and local taxes. It's one of the reasons why when you have effective tax rates and marginal tax rates start to diverge, you get the worst of both worlds, right? As the government, you collect less in taxes because the effective tax rate is low. But companies borrow a great deal because your marginal tax rates are so high. It's exactly why prior to 2017, the US had the most dysfunctional tax system in the world because its marginal tax rate was close to 40%. Its effective tax rate was close to what European companies were paying. But because the marginal tax rate is 40%, US companies got this incredible advantage to borrowing because the marginal tax rate is what drives the after-tax cost of debt. Carlos, you have a question? Is your hand up from before? Oh, okay.
Before, yeah, sorry.
So So everybody clear on pre-tax and after-tax cost of debt? Let's do the final piece of the cost of capital. You got a cost of equity, you got an after-tax cost of debt. Your cost of capital is a weighted average of those two numbers. And you open up any corporate finance evaluation textbook, it lays out the law, right? The weights have to be market value weights. I can't think of a single corporate finance evaluation book that tells you otherwise. I mean, you might get dances about you can't get the book market value of debt. You can use the book value, but at least the end game is the weights have to be market value weights. But there's another set of numbers out there that look like they can be used as weights, right? If you look at the balance sheet, there's the accountant's estimate of shareholders' equity and debt, which is book value weights. How many of you are working in your CFAs? Anybody working on a CFA? I'm surprised that nobody's working on a CFA. Become this, because you're working on a CFA, or you finished a CFA?
I finished my CFA, Professor Law. It's been 5 years now.
Okay. And it's become one of the most testing endurance games on the face of the earth, right? They make you read 7,700 pages and they say, what was on page 5,335? And when you don't know, they can fail you because they've got to fail about 65% of the people who take the test to keep the CFA accreditation valuable. So for you, I don't have a CFA. I don't want a CFA. I don't even think about getting a CFA, but for 30 years, I've been giving the keynote in the CFA conference that I have every year in New York. And every year I beg them, please this year, let me write the test. Because the tests you're writing are not testing people on whether they can do valuation. They're testing them on whether you can read 7,500 pages and remember what's on page 5,355. They won't let me do it. But if they did, my test would be one question. If you get the answer right, you get all 3 levels of the CFA. If you get the answer wrong, you got to go back and try again. And here's the question. You've got market value and book value weights. What's this thing about market value weights? Why do we use market value weights? And I'll give you the choice, and if you think this is the reason, kind of latch onto it. Is it because the market is usually right? What's the danger of picking that answer? If you tell me the reason you use market value weights is because the market is usually right, you're creating a huge potential problem for yourself. And here's why. Use the market value weights, you get a cost of capital. Use the cost of capital, you value the company. You value the company, and then you tell me the stock is undervalued or overvalued. You see the problem here? If you start the game by saying the market is usually right, you're trapped at the end because you can't tell me the market made a mistake on this particular company. So it can't be that the market is right because otherwise you're completely trapped. Is it because market values are easy to get? As opposed to what? Book values? I mean, they're easy to get too, right? You go to the balance sheet, there's shareholders' equity and debt. In fact, you could argue that market value of debt is more difficult than book value debt. So that can't be it. You could always take the cynical view of book values are estimated by accountants. I don't trust it. I would love to take that, and I kind of share that view, but that's far too cynical. I mean, let's face it, book values reflect accounting choices. I might not agree with them, but they have a consistency of their own. So the right answer is not there. So what do you think the rationale is for using market value weights?
I think that the reason is because the book value of equity is dependent upon the capital which was actually brought in initially and the profits which have accrued till now. It does not.
So what's wrong?
It does not reflect the actual equity value of the company, because the value of the company is actually dependent upon the future cash flows.
But you're saying the market makes a better judgment. You know what the accountant pushback is? The markets make mistakes all the time. I think this book value is a better reflection of what the equity is worth than market value. So I'm not disagreeing with you on the logic, but implicitly you're then saying the market gives me a better estimate. That's why I'm using it.
Yes.
I'll give away the answer. You're welcome to use it on the next CFA exam. Every discounted cash flow valuation is almost a hypothetical acquisition valuation. Here's what you're doing. You're acting like you're buying all of the equity in the company today and all of the debt in the company today in the marketplace. And if you do that, guess what you pay? I mean, let's say I want to do an acquisition of Tesla and I value Tesla at $500 per share, but the stock's trading at $900 per share. What do I have to pay to buy the shares? I have to pay the $900, not my estimated value. The reason we use market value weights is it reflects the acquisition cost of acquiring the entire company. Which means doesn't have to be right. It just is what it is. I can't fight it. So if I think a stock is massively overvalued, when I do the acquisition, I don't have a choice of saying, look, I'm going to pay a 90% discount on the market price. It doesn't work that way. We use market value weights because they reflect the cost of acquiring the whole company. That's why I try to get market value of debt, because I think I know you can get away using book value of debt for many companies because it doesn't deviate that much from market value, but why risk being messed up if you can get the number right in the first place? So now I'm ready to pull all the numbers together for Embraer, which is a company I've talked about off and on through the last 100 pages. So I'm going to do everything in US dollars because in 2004, there was no Brazilian 10-year government bond. Mansi?
So if you do that, if you use the market value, aren't you again pricing and not valuing?
That's true, but when you're an acquirer, what choice do you have, right? It's not that I'm saying it's right. I'm saying I have to take the pricing. So you have to be a price taker in the market, because you don't go around saying, I'll pay intrinsic value. You can try, but that's not what people are saying. So I think Facebook is massively undervalued. But when I go out and buy shares, I will pay the current market price, not the intrinsic value. There, it actually helps me that the stock is trading at below value because I'm buying it at the lower price. So I don't disagree with it. There's a pricing component, but it also reflects the fact that when I do an acquisition, I have to take the market price. So now let's bring it all together for Embraer. In 2004, the cost of equity starts with the T-bond rate because everything is being done in US dollars. It's the US T-bond rate. Beta 1.07, which is the bottom-up beta for Embraer based on Global Aerospace Company. A mature market equity risk premium 4%. That was the implied premium for the US in 2004. A lambda of 0.27. If you remember, I ran that regression of Embraer versus the country bond. And a country risk premium of 7.89%. Risk-free rate plus beta time. So if you don't want to do the lambda approach, of course, you could do the composite equity risk premium approach. It gives you pretty much the same answer, 10.7% cost of equity. Market value of equity was $11.04 billion. Now, note of caution, many of you are valuing companies with multiple classes of shares, right? Facebook, Google, etc. When you do market value, make sure you count all of the classes of shares, not just the shares that might be traded. You might have classes that are non-traded. All classes of shares have to be included in market cap. Yahoo Finance does that. So if you notice some of your companies, you multiply share price by number of shares, you'll come up with a value well below market cap. Yahoo is pretty good about market caps, including all classes of shares. For the cost of debt, I'm going to start with the same risk-free rate, 4.29%. Add 2 default spreads. 4% is for the Brazil as a country. 1% is because of my synthetic rating. 9.29% pre-tax cost of debt in dollar terms. Market value of debt is $2.083 billion. The way I computed market value was the way I described at the start of the class test. I took the book value of debt, $1.953 billion. I took the interest expenses, $222 million. So think of this as a gigantic coupon bond, face value of $1,953 million, coupon of $222 million. And the average maturity was 4 years, and I discounted them all back using my pre-tax cost of debt. What I get as a present value is the $2,083 million. So this company is about 84% equity, 16% debt, cost of equity, cost of debt. 34% is the marginal tax rate in Brazil, which is where Embraer keeps almost all of its debt. Gives me an after-tax cost of capital of 9.97%. So it took us a while to get there, but that is my dollar cost of capital. Many of you, if you're valuing emerging market companies, especially in countries where currencies are kind of tricky, might decide to go the dollar route. Nothing wrong with it, as long as your cash flows are in dollars. But let's say after you've done your dollar cost of capital, for a company like Embraer, you said, you know what, I want to do everything in reais. You're allowed to change your mind. Now, one way you can build up to a real cost of capital is start from scratch again, start with a risk-free rate in reais and build up. But there's a quicker way you can get there. And this is one of the neatest tricks in finance for going across currencies. I have a 9.97% dollar cost of capital, right? I want to convert it into a real cost of capital. Simple adjustment. Get me the inflation rate in dollars. Let's say it's 2%. The inflation rate in reais is 8%. If you're in a hurry, just add the 6% differential to the 9.97%. You can go across currencies in seconds if you have expected inflation rates. You give me a rupee cost of capital, say, I want a dollar cost of capital, I subtract out the differential inflation. If you want to do it right, there's a compounding effect, which is what the 1.08 divided by 1.02 does. My overall cost of capital is 16.44% in reais. You want me to do it in euros? Not a problem. In yen, not a problem. You can move across currencies easily. And that's a good skill to have in a world where people have different frames of reference when it comes to currencies. Final point about cost of capital. I've acted like there are only two ways of funding a company, right? Debt and equity. But there are companies which kind of create what are called hybrids. You know what a hybrid is? A hybrid is part debt, part equity. I'll give you two standard examples of hybrids. These are the most common examples. One is convertible debt. Convertible debt has a debt component, obviously, but it's also got an equity component. That equity option to convert is equity. I'm going to argue that if you have convertible debt, the best thing you can do is break the convertible bond into its debt and equity components. I'll give you a very simple way of doing it, but basically you break the debt and then you put the debt part into debt, the equity part into equity, and move on. The financing that really gets, it's the one that I hate seeing on a balance sheet, but it's not your choice, is preferred stock. Preferred stock in Latin America is really common stock without voting rights. Preferred stock in the US is like a bond. The way it's like a bond is when a company issues preferred stock, it sets a fixed dividend. It's like a coupon, right? It agrees to pay that fixed dividend. So you're saying, I'll treat it like that. The problem is it doesn't come with a tax deduction. So I can't include it with that. I can't include it with equity just because it's called preferred stock. It's got nothing to do with equity. So with preferred stock, you almost have no choice but to open up a third source of capital. You got equity times weight, cost of equity times weight of equity, after tax cost of debt times cost, weight of debt, plus cost of preferred stock, which very simply is just the preferred dividend yield, right? So you have a stock, a preferred share with an $90 price, and you're paying a $4.50 dividend. 4.5 divided by 90 is a 5% preferred dividend yield. That becomes the cost of preferred stock. I'll tell you the sectors you're going to run into with preferred stock are mostly financial service companies. You know why banks like to issue preferred stock? Because it's counted as part of regulatory capital. It allows them to borrow money without, it comes at a consequence, right? They lose the tax advantage. It's a terrible way of financing if you think about it, right? You're lending, you're borrowing, it's really expensive debt. That's what it becomes without the tax benefit. But for some companies, it works in their favor. And if there is a lot of preferred stock, you have no choice but to open the component. But let me talk a little bit about, I said with convertible debt, you want to break it up into debt and equity components. That sounds like it's complicated, but it's actually very simple. And to show you how it's going to work, I'm going to give you a company which has a convertible bond outstanding. The face value of the bond, which is the book value of the convertible debt, is 125 million. The stated interest rate, coupon rate on the convertible debt is 4%. It's got a 10-year maturity, and the market value of the convertible bond is 140 million. So I've given you the book value of the convertible bond, the coupon rate, the maturity, and the market value. I also tell you that this company has a bond rating of single A, and single A rated bonds have an interest rate of 8%. So if this company had issued a regular bond, the coupon rate would have been 8%. That's the opening I'm going to use to break my convertible debt into its debt and equity components. Here's what I ask. If this convertible bond had been a straight bond, in other words, it didn't have a conversion option, what would I pay for it? The answer is, I definitely would not pay face value because the coupon rate is only 4%. So I take the coupon on the bond, 4% of 125 million. I'm going to pay that as, I'm going to get that every year for the next 10 years. I'm going to get 125 million at the end of the 10th year. So valued purely as a bond, the value that I get for the bond is 91.45 million. So take the convertible bond, value it as if it were a straight bond without the conversion option. Its market value is 140 million. That difference between what the market value is and what the bond component is, 48.55 million, is the value of the conversion option. So you know what I'm going to do? I'm going to take the 48.55 million, throw it in with the rest of my market cap equity. I'm going to take the 91.45 million, make it debt. My convertible bond is now gone. I no longer have, a third component. It's now been decomposed into debt and equity. Now, of course, those of you like using the option pricing model, I'm not one of those people who loves pulling out Black-Scholes just because I feel like. If you want to use an option pricing model, you can value the conversion option as an option and treat the rest as debt. You make your choice as to which is easier. It's easier to value a bond or easier to value an option, because value only one half of the bond. So whatever you choose not to value is whatever the remaining number will be. Carlos?
Where did you get the 140 million, the market value?
Because convertible bonds are traded, right? There's a market price in the bonds. I went to the market, looked at what people were paying for the bond. So it's a market value.
Always, right? Like they are.
If it's traded, there should be a price, right? So if it's not traded, then use the 125 million as if it were the market value. But if it's traded, there should be a market price. Right?
Thank you.
Wakas, you had a question, or your hand went up and it went down?
Yeah, I had a question regarding if the market is dysfunctional for these instruments, then probably both these measures, Black-Scholes and this one won't work, or how would this go?
Well, the total values. So you're saying the total value is wrong. The 140 million is wrong because all the market does is price the convertible bond.
So if the market is dysfunctional for these instruments,
when you say dysfunctional, I'm not sure what that means.
I'm saying that it's like the debt securities are not traded that often and the prices are not.
Okay, so the pricing is not reliable. So, okay, I get this. So the 140 million is not there, or you don't trust it. You're saying, what do I do? Let's use the 125 million then. Use the face value of the debt. Because you have no choice then, right? Or do both parts and remove the market entirely from the process, right? You can value the straight bond, you can value the option as two separate.
Would option work if the prices are are a little dysfunctional? Because
well, remember for the option to work, all you need is the stock to be traded. How dysfunctional is this market you're describing? Nothing in the market is reliable.
Well, if a company is very thinly traded and the debt is also thinly traded, so it becomes a little tricky.
Well, this is the least of your problems then, right?
Yeah.
That's how you're going to get the market cap for your equity.
Yeah.
Right. So this is not the hill I would die on then, right? I have bigger hills I'm going to be slaughtered on. This would be the least of my worries. If I don't trust the market price for my equity, my market cap is going to be off as well.
Sure.
So I'm saying if you have an issue that stretches across securities, this is the least of your problems. This is just one small part of a very big problem.
Sure. Thank you.
So let's recap the cost of capital, right? You got a cost of equity coming from your currency choice, your beta, and your geographic spread. Your cost of debt reflecting your default spread as a company, your tax benefits. So weights are market value weights. You bring them all together, you got a cost of capital. And if you have a company with significant preferred stock, have a third component, cost of preferred stock times weight of preferred stock. Any questions about discount rate? Because this is it. We're not going to talk about discount rates from, it's like Bruno. It's off the table. No more talking about discount rates for the rest of the semester. I think we spent too much time on discount rates to begin with, but I want to put it to sleep. Fawad?
Hi, Professor. So I have a question about discount rate. So I see many people use constant discount rate. And let's say I'm valuing a company that expect to repay its debt principal annually. So in this case, if I know the expected repayment schedule, is it okay to use kind of like the dynamic discount rate?
Yeah. Or it goes to, I mean, let's face it, debt ratios, every component of the cost of capital can change, right? Your debt ratios can change, your default spread can change, your business mix can change, even the risk-free rate could change. If you think that, what the Fed is doing is going to push up rates, everything in your cost of capital is changeable. It gives you a huge amount of freedom because you're not stuck with what do I do when things are changing.
All right. Yeah. Thank you.
So let's open the door to earnings and cash flows. Right? Ultimately, you got discount rate, that's a denominator. Let's talk about the numerator. I'm going to go through cash flows in 3 steps. I'm going to start, before I get ambitious, by nailing down what the current earnings of the company is. It's kind of silly to talk about future earnings if you don't know what your company made last year. That should be in the income statements, right? I'm going to argue it might or might not, depending on how much you trust accountants. I'm going to start with that. I'm going to argue that if you're looking at cash flows to equity, the earnings measure you need is a net income number. If you need cash flows of the firm, you got to start with operating income. Then I'm going to move to how much the company is reinvesting back for future growth. Now, that can be in land, building, equipment. If you're a manufacturing company, it can be something less tangible if you're a technology company. So I'm going to look at how much you reinvest for future growth. And then I'm going to look at, if you're a cash flow to equity, how much debt you repaid or took on during the course of the year. So this is nothing about the future. This is just about last year. What did you make? What did you reinvest? How much did you return to debt or took on as additional debt? So let's look at the big picture of cash flows. There are three ways you can estimate cash flows in a DCF. One is you can say, look, I'm just going to take what the company pays out in dividends and buybacks. That's an equity cash flow. I'm not going to play arbiter of what the cash flow is. This is my actual cash flow. There are lots of people who adopt that view of DCFs. They say all this free cash flow stuff, you're dancing on things that cannot be calculated. I need to see money in my pocket, and dividends and buybacks are the only money. So think of that as the most rigid definition of cash flow to equity. Look at what companies actually pay. The problem with that is we know companies don't pay what they can afford to. So a more realistic estimate of the value of equity looks at what companies can afford to pay out. This is what I call free cash flow to equity. Sounds fancy, but here's what I do. I start with net income. Why? Because it's equity cash flow. I add back depreciation, then I subtracted CapEx and change in working capital. And then if I have debt that needs to be repaid, I repay it. So think of this as the cash left in the till at the end of the year if you run your own business. It's free cash flow to equity. Could it be different from dividends? Absolutely. But they're both equity cash flows. They're after debt payments. One is you're looking at the company and assuming it's paying out what it can. The other, you're estimating it on your own. And the third way you can estimate cash flows is to the entire business, pre-debt cash flows. To get that pre-debt cash flow, instead of starting with net income, I start with after-tax operating income. Why? Because net income is after interest expenses I need to climb up. I subtract out reinvestment. Right? The way we traditionally define reinvestment is reinvestment in long-term assets, which we measure with the difference between capital expenditures and depreciation. Already your accounting classes are kind of clouding your definitions of those. We're going to redefine them very differently. But also investment in short-term assets. That's what change in working capital is, right? What you're investing in inventory and receivables because you want to grow. Make this choice upfront. Decide whether you're valuing equity of the firm, because the way you estimate cash flows is going to be different. But in all of these approaches, guess what I start with? I start with the measure of accounting income. Now, incidentally, as you look through my evaluations and you look through practice quizzes, problems, you'll notice that there seem to be multiple ways I get to free cash flow. It looks like I have 17 different ways. Let me kind of take my free cash flows and show you different ways of rewriting it. So you can see that I'm doing the same thing in every single case. So the long way of doing it is you take EBIT times 1 minus the tax rate minus net capex plus change in, this is the way all textbooks define it, which is fine, right? But if I take this entire item in the brackets, net capex and change in non-cash working capital, and replace with one word, because it's really reinvestment, right? Whether it's long-term or short-term, I can rewrite free cash for the firm as EBIT times 1 minus the tax rate minus reinvestment. And if I wanted to get really fancy, I say, why am I defining reinvestment in dollar terms? I can take the reinvestment and divide it by the after-tax operating income and define it as a reinvestment rate. So if you see these three approaches, they'll give you the same answer at the end because you're getting to the same place. There's three ways of framing the same question. But in all three approaches, there's something I'm ignoring when I do cash flows. And I want you to tell me why I'm getting away with doing this. You know what I'm missing? Remember when you have interest expenses, your taxes go down? You get tax savings. I am ignoring those tax savings when I do free cash flows of firm. I'm acting like I have no tax savings from interest. It sounds silly, right? Because I do get tax savings from interest, but I'm ignoring them intentionally. So I have a question. Why, when we do free cash flow to the firm, do we ignore the tax benefits from interest expenses? Alex, you want to try? Why do we ignore the tax benefits from interest expenses when we do free cash flow to the firm?
I'm not sure, but I just saw a note saying because of our cost of capital.
In fact, let's flesh it out. What do I discount the cash flow back at a cost of capital? Remember what went into cost of capital? A cost of equity and after-tax cost of debt. Our discount rates already count the tax benefits from debt. And if you include it again when you do your cash flows, you're double counting the same tax benefit. I'll tell you a way in which this slips in and people don't even realize it. A lot of people, when they do free cash flow, the firm will take the after-tax, or will take the operating income, and instead of doing the 1 minus T, they will actually take the taxes paid and subtract it out. If you do that, you've just double counted. You know why? Because the taxes you pay will be lower because you have a lot of interest expenses. And if you build it into your cash flows, you've double counted the same tax benefit. So somebody pushes, why ignoring tax benefits when you do cash flows? It's because it's already counted in when you do your cost of capital. You can't double count it by also counting it in your cash flows. So let's talk about estimating cash flows. I say a lot of mean things about accountants, and I mean every word of it. But having said that, though, every measure of cash flow starts with a measure of accounting earnings, right? Net income, operating income, which means if accountants screw up really badly on earnings, I'm going to be screwed up on my cash flows. So my first stop when I look at a company is to make sure that the earnings number that I'm using is a number that actually reflects true earnings. Sounds like a crazy thing to say. Why wouldn't it? Well, first, I want to make sure it's the most updated number I can get for this company. I'll come back and flesh that out. Second, I want to make sure that if you're a cyclical or a commodity company, that base year number is not some strange number. Maybe something bad or really good happened last year and it's pushing the number down. So I've got to update, I've got to normalize or clean up. But third, I've got to clean up after the accountants because they're not always internally consistent about how they compute earnings. In theory, this is what my accounting professor said they did. They took revenues, they subtracted out operating expenses, which are expenses designed to create benefits only in the current year to get to operating income. And from the operating income, he said, we subtract out financial expenses to get a net income. In other words, all of earnings measurement is based on accountants putting things into 3 buckets properly: operating expenses, capital expenses, and financial expenses. And we know conclusively that accountants don't follow any consistency here. There's one financial expense that through time until 2019, they treated as an operating expense year after year after year. And you know what I'm talking about, right? Operating lease expenses. Finally, in 2019, they've come to their senses, but it took them 70 years from knowing there was a problem to fixing it. Here's another item that increasingly we'll run into where accounting inconsistency looks us in the face. If you're a manufacturing company, your CapEx takes the form of land, building, equipment, machinery, right? Which is treated as CapEx. If you're a technology or a pharmaceutical company, if you define CapEx as what you're investing for future growth, what's your biggest CapEx?
R&D.
R&D. And what do accountants do with it? Screw it up big time.
It's an
You
expense.
can't wait for accountants to come to their senses on this, right? It is definitely a CapEx. In fact, it's super CapEx. What company in its right mind does R&D expecting to get a benefit in the current year? So we're going to talk about cleaning up accounting expenses. So let me at least lead in with this updating number. I hope all of you have picked a company. Notice I didn't ask you that question. I'm assuming you've picked a company. I'm assuming that you've also looked for the most recent annual report for your company, right? Because that's where the bulk of the information is. For some of you, that annual report, you're lucky, is 2021. Because the company has done all the filings, it's updated through 2021. But for some of you, the most recent annual report is going to be 2020. You're saying, what's the big deal? Come on, do you really want to use 2020 as your base year when you're sitting in February 2020? 2020 was a disaster for companies with COVID. But this goes beyond that. When we talk about valuing a company, we're valuing it as of right now. Who cares what the value of your company was as of January 1st, 2021? You're in February 23rd of 2022. You want the most updated number you can get for every single input. And much of the word, there's a replacement for the most recent annual report, right? If I want to value Apple today, their most recent annual report is through September. They go September to September is their year end. I don't want to use the September year end number, but I can take the last 4 quarters and add them up. It's called trailing 12 months. It's very simple to do. All you need is one 10K and one 10Q. In fact, I'll put up a very short webcast about how to create trailing 12-month numbers with a 10K and a 10Q. But what I'm creating is in the most recent 4 quarters, what did this company generate as revenues, as operating income? Because the end game here is you want to value a company based on where it is today. So updating is key. And it's easier in some companies than others. And because of online filings, it's become much quicker. From when I valued the Fangam stocks, the 4th quarter numbers are already shown up on SEC on their own website. So I was able to get the trailing 12-month numbers, which really reflected calendar year 2021 for every single company. So that's updating. Let's talk about cleaning up for accountants. As I said, there are a couple of items where I'm going to focus on. One is operating leases, which I think are beyond any kind of debate, financial expenses. They've always been financing expenses. And the other is R&D, which I think is beyond any debate, a capital expense. So I'm going to start with operating leases and talk a little bit about why this is such a big deal. There are some sectors where the way companies borrow money is through leases. And I've listed some: air transport, trucking, restaurants, apparel. These are companies where operating lease expenses are huge as a percentage of operating income. But there are other sectors where this is a non-issue. So you can already see why this is not as much of an issue if you're looking at a steel company or an insurance company or a financial service company, and more so with retail companies or restaurants. But let me make the case for why leases are debt. And then we'll talk about what accountants are doing now to capitalize leases, because this is something I've been doing for 30 years while I was waiting for accountants to come to their senses. What is it that makes debt different from equity? Equity is a residual claim. Debt is a contractual claim, right? Which means debt payments you got to make in good times and bad times. You don't have the flexibility of going to your bank and say, guys, we had a bad year. I'm not paying you interest this year. Now think of what a typical lease commitment looks like. You've signed a lease for the next 10 years. Contractual commitment? Absolutely. That's enough for me. If you have a contractual commitment and not meeting that commitment can potentially put you into default, it's debt. There's nothing to debate beyond that. Now you can argue you could talk about whether it's more like subordinated debt or senior debt, more like junior debt or senior debt, but that's a debate about what kind of debt it is, not whether it's debt. And converting lease commitments to debt is almost a slam dunk. It's very simple to do. All you need is an estimate of the lease commitments that a company has for the future that you need as your input. And if you discount those lease commitments back to today at your pre-tax cost to debt, what you've effectively done is converted lease commitments into debt. Of course, when you do this, your operating income also has to be adjusted. You can't go with the old operating income because that number has now become a number that's shifted because of what you've done with lease debt. So I'll leave you with this conversion at the gap and what it does to your numbers. So this was in 2003 when accountants were in their old ways treating lease payments as operating expenses. I took the lease commitments that the gap reported for the next 5 years and then a lump sum beyond year 5, because that's how US companies have always reported. So it's a footnote to the balance sheet. So even though it was not treated as debt in the balance sheet, the gap said, by the way, guys, we have lease commitments for the next 5 years and a lump sum beyond year 5. I took the lump sum beyond year 5 and just spread it out over 2 years. The pre-tax cost of debt for the gap in 2003 was about 6%. You discount each commitment back, so 899 1 year, 846 2 years, and the commitments beyond year 5 as well. What you get as a sum of the present values is $4.4 billion. You're saying, what does that even mean? It's going to show up in my balance sheet now as the debt value of leases. of course, the balance sheet has this unpleasant requirement, which it has to balance. So when I treat something as debt, I've got to create a counter asset. And when I create a counter asset, I've got to depreciate that asset. One of the things about converting an expense from an operating to financial expenses, your work just got started. You can't just move the item. So here's what happens. My debt is now going to increase by 4.4 billion. The gap really owes more than $6 billion. Second, my operating income, where they stated was 1.012 billion, I'm going to add back the lease expense from this year, saying I should never have subtracted that. It's not an operating expense, but I'm going to subtract out what I'd have had as depreciation or amortization on the lease, because if you're treating the lease expense as debt, it's going to create an asset that gets depreciated. Long story short, I'm going to have more debt, a higher operating income. In fact, there's an approximation that some people use where you start with the stated operating income and just add back the interest expense you'd have on that debt value. But in effect, every number at the gap will now get restated because the choice are made of converting leases to debt. So I want you to think about this. And if your company has lease commitments, try to convert those lease commitments to debt on your own, even though accountants are doing it for you, so you can see the process play out. And next class, when we start, we're going to talk about why this matters. Why do we go through this pain of converting operating lease expenses to debt? What does it change about the company? And we'll also talk about converting R&D into an asset. So I'll leave you with that, and I will see you on Monday then in class. So this is not on Zoom anymore. We'll be back in the classroom. Take care, and I will see you Monday. I'll hang on for about 10 minutes in case you have